Matrix Asset Advisor CIO David Katz joins us now. David, welcome. And first of all, do you find it an opportunity or frustrating as an investor, the back and forth here, the way we're all trying to tease out these headlines and figure out what's really going to happen with these trade deals?
Both. If you're trying to play the comments on a daily basis, we think you're going to go nuts. We think the best thing to do is take that longer term vision, buy really good businesses and buy them on the days that the market is depressed or sad. Do it on the negative comments. Don't chase the rallies like today, because the government and the administration is changing its mind on a daily basis. We think you have to look about 9 to 12 months out, and you have to assume and hope that ultimately saner minds prevail and they back off from some of these tariffs. And basically what Bassett said today was exactly right. The situation is so bad that it's got to change and it's got to ease.
So where do you know that you can kind of go to the sidelines while this all gets worked out? Because you can't really go to the sidelines. I mean, the kinds of things we're talking about affect so many different kinds of businesses, and not to mention if we have a recession.
Well, you're exactly right. It affects all businesses. We think that you have to stay in stocks and you have to look out 12 months and not get overly concerned about the daily moves. If you're looking for a more conservative area within the stock market, we'd focus on some dividend payers. They generally will be more protective on the downside. You're getting paid a good yield while you wait. But we also think at this point you can buy some of the more aggressive areas that have just gotten creamed. We went into the year cautious on Mag 7. We think at this point most of them are pretty attractive.
Amazon being one. You're also looking at AMAT, at Lowe's, Wells Fargo, so kind of a mix of companies there. What about gold? I don't know if you have any exposure to it in the portfolio, but do you look at that and wish you did?
Well, we wish we did a year ago, but at this point, we would not be putting money into gold. We've read a number of things that talk about it being one of the most overcrowded trades out there today, more overcrowded than the Mag 7 last year. We think people are buying it because they're scared about everything else. And if the tensions ever cool and the market starts to do better, we think all of that gold money is going to come out. So we think your upside is very limited. Your downside probably is 20 to 25%. And we think, again, 12 months out, you can make 20 to 25% in the stock market. So we think that's a much better place to be. If you don't want to be in the market, we would keep it in cash rather than putting it in gold as a secure place.
And what about, and by the way, your comments are echoed by the likes of Dennis Gartman and others who have been longtime bulls, but say, look, this is getting out of hand. It's looking almost like a bubble. So just curious on bonds, which often, play some role in the portfolio, but people are a little confused about that right now. Should they be hiding out in T-bills? Like you said, if there's a sense, well, I can't go in cash because of inflation, do I go to T-bills? Do I go to the longer end? And to your point, hope that this all kind of gets resolved and things calm down in the next couple of months?
So for balanced account, we do like short-term bonds, 1 to 4 year bonds. We absolutely would not buy longer-term bonds. There are lots of concerns there. If tariffs play out worse than we hope they do, that's very inflationary. If the president tries to force Powell out, that would be very bad for the bond market. So there are a number of things that are concerning on the longer-term bond market. We'd stay away from there. We'd focus on 1 to 4 year bonds. And again, we would be buying into stocks here into this significant pullback.